So I want to get back to the questions. Like the way that I trade, I mix long-term holding together with short-term. So what I want to tell everyone is like, don't concentrate on one little things like short-term. I think it's like in this kind of market, yes, you can go for short-term because like it's very dangerous to have like all cash into the market. And I last time I talked about dividing up your portfolio into two parts. I myself actually have three parts. I have the long term, which is 2+ years. Sometimes even I don't even think about selling unless I see a reason that I need the money. Second portion is medium term, that is 3 months to 9 months. And those things are including like 60 DTE. I consider that as medium term, that you get more premium and you have more time to adjust. And when you see something wrong, then you have time to react to it. So the short term is the one that I consider as day trading, CODTE, or anything that is under 3 weeks. I consider that as short term. So I suggest people to divide up their portfolio into 3 sections. And I would say like majority of your portfolio should be in the long-term view, meaning that you buy and hold, but you use the income, you use your short-term portion of it to earn income. The reason why I recommend this is, let's say you buy Apple at 180, or if you're not lucky, right? You buy 180, it goes down to 150 easily, and then you look at it and you already invest, and all your asset is tied up in that stock. So instead, you use cover call, or you use cash secure put, and you use like cover strength, or all of those strategies to mix with your long-term view. And you can always use options as a way to acquire stock. And that's how I start out in 2016. I looked at AMD and I look at it. Oh man, this lady is good. So how do I trade it? I don't use like in the beginning. When it's $12, of course I have some money to buy the 12. But then when you get to $50, I don't have that much cash. Then what I do is I buy the LIPs in the money LIPs, and I also sell like cash secure put. And those are really good ways to get into the one stock, and then you use the option to acquire the stock. LIP is a good way to acquire the stock. Cash secure put is excellent way to acquire the stock, and you always have a long-term view. For all those companies that you are comfortable with, have a long-term view, but you use whatever that you know about option and trade option for income, and you balance it out. Actually, the way I see option is, to me, is a hedge against your long term. So my overall portfolio, let's say, I just give you an example, 70 to 80% is long term. I put it in, I don't even think about it. When AMD, it was 160 and now it's 130. I don't falter. I don't even check the account. I just forget about it, because my long-term view has not changed unless something critical happened. Let's say the company, Lisa Su, is going to retire. The fundamental is remain the same. You don't change. You don't get panic. You never get panic when something get drastic happen. You reassess the situation. So when you try to do any approach, I suggest have a holistic approach, meaning that you don't look at one stock in your holding. You look at your overall. So your portfolio should be, a portion of it is long term. You have to tell yourself, don't falter, don't give in easily, don't panic. In other words, you don't panic and follow whatever that someone tell you, or because you follow the news and you try to react to it. The market in general is overreacting. So if you overreact with the market, like you're just like everyone else, you have to have your own thinking. You have to have like your own set of things that is independent of what I tell you and what other people tell you. So I like investment and trading because everyone has their own freedom to learn. So what I suggest you to do is like have a set of, let's say, 10 to 20 stocks that you're really comfortable in. So you have a set of stock that you study. It does not, I don't suggest you to buy all of them at once, but you buy them not at the dip, but you actually acquire them at critical time that you believe that is undervalued, or you believe that the growth trajectory is what's there and is like, for example, now I don't recommend you follow what I'm saying, but then I give you an example. I recently I take interest in Alibaba. I used to own a lot of shares of Alibaba, and then I cash out, and then I change it to something else. And because it go downturn, but now I think it's undervalued. But so when you, for my investment, the most important thing is you have to limit it to 1 to 2%. If your portfolio is over $1 million, I even recommend 0.5 to 1%. So you can have you can use cash secure put to buy Apple, and then later on you have 1%, and then you can buy a leap option. That's, you can consider that as two separate, because they are different stripe and different vehicle of like acquiring the stock. But the end result, if you have multiple of them, then you have too much in one basket. Then for any kind of stock or things, I would say like make another rule, don't exceed over 5%. But I would say the best way to do is like, so that you, every one trade of your portfolio is no longer than 1%. The reason why I do that is to avoid you to get stuck in one stock, because when you have one stock that's losing $500, it's so easy to just kill it and get rid of it and then start over. But if you have one stock that is losing tens of thousands or even $100,000, then it would be extremely difficult to move. So what I suggest people is like, you form your rule. My golden rule is try to have less than 1% of your working capital. Your working capital, to me, it means your cash and your 401k, like all those things that you use for your investment. So that's number one rule. Number two that I highly recommend you is to think about the planning. When you get into a stock, make sure that you know, have a plan to say why do I invest in this? Do I follow someone? I highly encourage you to have your own bias, to have your own opinion that you like that company. You buy not because he told me to buy AMD. No, you study a company. I give you like a lot of information in the website that you can study a company fundamental analysis. You can look at the chart. You look at the technical analysis. So those components would form a basis for you to follow a stock. So do not follow, like, you can follow hundreds of stocks, but then like in reality, you would invest like maybe 10 to 20 stocks. But invest in those companies, especially in this time, invest into the growth prospect, invest into fundamental. Do not invest in those like very like meme stocks. So those you can use for speculation. That's okay. So when I say you divide up your portfolio into a long-term portfolio, like 70%, you are in like something that you like. I would say, like, if you are beginners, don't even trade individual stock. Go with something like inactively managed index, like for example, like S&P index. You go with something like Vanguard is really good. Fidelity Growth Index is very good. All those are very low expense. So for the long-term portfolio, if you know how to pick stock, yes, you can do that. But if you are too scared of doing your own thing, don't even think too much. Just go with the stock. Like let's see. All right. So anyway, so to get back, so number two, besides the 1 to 2% rule, I would say have a plan to know why you invest that stock and study that stock. Do not follow what other people say. Have your own thought about a stock, because you justify the reason why you want to enter the stock. So if that fundamental, that thesis is the same, you don't change. So those are the long term. But for meme stock, yes, no problem. I trade meme stock, AMC, GME. I trade it, like I have really good return on those stocks. I don't mind, because a stock that is like volatility is high, implied volatility high, and the premium is high. And if you know how to you track it, you have a feeling of it, you are not scared of it, you can do it. I still trade those stocks, but trade it in short term, meaning that you have a target to say that much profit, I would be out, and that much loss, I would be out. So you have an exit plan, you have an entry plan. And why do you have the exit plan? Because this is the problem. Even I myself today have problem is I don't plan the exit thoroughly. The best things to do the trading is to have the plan. How do I take profit, and how do I defend a trade? When they get to certain point, I will just get out. And because there are times that you always ask the question, what if, what if? If you do the planning well, you actually write down, like, if I lost more than 20%, I'm out, or maybe I use the formula 2 times or 3 times. I actually don't like to use 2 times and 3 times, because each stock should be treated a little bit differently, because depending on the confidence you have on the stock. So I want you to be passionate about owning on certain things, because there must be a reason. You must have your reason you own it. So when you buy a stock, when you invest in something, always have a thesis behind it. If the thesis stay, like me, I'm heavily invested in AMD because I believe in the company that has like good prospect, good growth, and good revenue incoming, and they have lots of good product coming. So I attend every single earning release. So I know everyone, most of the critical people in the company, and when they say something, I follow. When there are rumors or analysts, I know which one is like kind of BS thing, or just most of the analysts cut and paste of other people is actually irrelevant. Do not listen to other people unless they have a point that is worth listening. But when you follow a company a long time, you will know some of them are just bogus. It's not worth your time to spend the time. So you know that after a while. Let me see. So that's number 2, and use fear in your plan. Don't use fear for your execution. So when you plan the stock, it's okay to be fearful, because when you are fearful, you consider the is it PMI? I think you should turn off your audio. You know how to mute yourself? Please mute yourself, because all right. So then what happened is I forgot my thought. So use fear to do your planning, because when you fear, you think about, when you use fear, think about when you get losing, what you do. Okay. So my thinking is, once you have all the complete planning, when I go execute a trade, I don't fear. I just like follow the plan. When you follow a plan, there's nothing to fear, because you have your mental stop loss. You don't need to use stop loss. And I myself use alert. I myself use manual stop loss, because the way that I trade, I don't trade 0 DTE. For 0 DTE, the stop loss is critical, because like if you don't use it a lot, I mean, then you would get into a problem. Because I don't look at the screen all the time. So everyone trade differently. Don't judge other people because they don't trade the same way as you do, because everyone is really different, and everyone has their own set of tools. And I don't judge other people using the set of tools. For example, I'll give you some examples, and Joe can tell that sometimes I go for some risky stocks, and then I have a lot of loss. And I was thinking that I wish I trade like Joe, to be more conservative, to go with like all those big guys and pay you dividend, that sort of things. Sometimes I do wish I don't have that, because one of my problem is I'm kind of like a gambler in nature, that I want to gamble, that I find it fun to gamble something, but it's not for everyone. So, but everyone is different. I would not judge Joe to be, oh, he's just too conservative. I don't do that. But there are certain times I wish I can be like Joe. But there are certain times that I wish to be. I think I'm right, because I'm on the uptrend, onto something that is big. So I have to strike a balance. There are times that you should be fearful. For example, like this time, try not to be too bold. I would say, like, in this kind of market, it's better to have as much cash as possible. So in this type of market, that's the best time to think about. Look at your overall portfolio. Don't look at one particular stock. You look at your overall portfolio. It's okay to have a bunch of red. There's I mean, to me, most of my stuff is red. It's okay. I mean, it's not okay to Joe, but to me, it's okay because I have risky stuff. But the thing that you have to think about when people are attacking you, and your overall portfolio is down, then you have to ask yourself, which one is the sucker that really take you off? Like you cannot even sleep really well. But I can guarantee you, if you follow your plan, and you have a trade psychology and also like setup that you follow the rule. So set up a bunch of rules to safeguard yourself. For example, like 1% rule, that is the golden rule to go to. Another rule is like if in a single day, if you lose more than $10,000, stop. I don't care what it is. If you have lost, you realize loss or unrealized over $10,000, stop any trading. So that is against, because when you are in a fear state, you tend to make mistakes. You tend to jump in and try to defend your trade, not without your cool logic. So always have a set of rules that has proven to work, and you stick to those rules. Everyone's rule is different. Do not copy someone else's rule. Use your own judgment, because okay, so yes, so everyone is different. Everyone try to do try to be responsible for yourself. When you there's one rule that I follow, is on you. Your investment is all on you. When you make money, it's on you. When you lose money, it's also on you. So you have complete control. You don't listen to other people for your own trades. You make your own decision. You are your own advisor. You are your own financial advisor, controller. Look at a company. So I recommend not just technical analysis. There are certain times that you have to understand the earning report, the earning release. Look at the cash flow. There are many metrics that you can look at a company to compare a company, which one is healthier. You always look at the debt ratio, you look at the cash, and see if the cash flow is positive. See if they have yeah. So, well, the 1% rule is very hard to follow, especially when you have a small account. I would try to if you have a very small account like $20,000, I would try with like maybe 3 or 4%, but do not kill yourself. But the idea is to safeguard you from making mistakes. That's what I'm suggesting. So if you have that philosophy or that kind of principle, then you gear towards yourself. Don't overtrade on certain things. I can tell you from experience, especially when I start out, we get carried away when we make money. It's very easy to make money, but it's very hard to keep your fortune. That is really hard. If you take it easy, you're not full-time trader, you're a part-time trader. That is the best, to have some certain amount of gain and then get out. And do not think about you invest all the time is the best, because this kind of market is very dangerous, right? So I prefer you to have cash and look at opportunity. So look, I suggest people, I'm a different guys. I have like 5 or 6 different strategy, and each strategy is identified to match certain type of market. In this type of market, I like to use Strangle, because that is like staying neutral, and I'm not biased, because this thing is so crazy. One day it seems to be down, the next day it just falter. So, and also in the last 2 months, I trade much less. Like I always trade like maybe 1/3 of what I used to trade. Why? Because I can see things that is like good to bet on. So instead I trade on the futures, because future is when the strength or RSI is really strong, you look at the trend and don't bet against the trend, bet with the trend. It's easy money. I mean, not easy money, you can have a reversal, but you don't have a bias on certain company. You go with the overall trend, stay with the long trend, and it's going to help you. So when you trade for a number of years, then you have a arsenal of strategy to work with the market. So the ideal things that I would suggest you to do, have a long view of the market. If you have a long view of the market, most likely is in 10 years is an uptrend, unless something really, really bad happening, right? But that I don't see that happening. So it has a long view, a bullish view trajectory. So if you spread it over time, the money in the market is always beating bonds, beating like your average CD or fixed income, right? There's no question about it. So why would you go for a 1% CD, whereas the average of the S&P is like 12% over 10 years? Why? I mean, like you cannot sell me that logic, right? So always have a long view of the market. In the short, in really short time, you can have like 20% down, that is 30% down in 2008. And then many of my funds that I don't take out in 2008, and the next year, most of my fund come back up from 30% down. The next year, you go back up 20%, right? Imagine if you get scared, you take it out, and you are timing the market, right? So what I'm talking about is the long-term portfolio. You don't need to change it all the time unless you have a good reason. I know there are some people that get out and they may be right, but what I'm saying is we are not sophisticated people. It's like we are very indecision. So I think the better approach is you divide up your portfolio on the short term. When you get scared, get out and remain that 30% all in cash, and then you look for opportunity. But when you look for opportunity, do not, I mean, people saying buying a dip, you never know if today's low is actually tomorrow's high. You never know. So try to have some long kind of like a technical analysis to see something rebounding. And you know when something like last week, it looks like a rebound to come back, like there's a trend that is formed breaking the trend line, then you are more comfortable to come back in. But even last week with the consumer price index, the CPI come out to be 7.5%, whereas everybody was thinking it's 7%. That is a big blow to the market, right? So that is like unexpected. So the other things that I want to, okay, so besides this, I want to talk about certain things. If for fundamental analysis, there is a website. Can you guys see it? Can you guys see the screen? Oh, I did not. I don't know if I share the screen. Okay, just a second. I'm sorry. Okay. Can you guys see the screen? Hello? Hello?
Yeah, now we can see him. Yeah.
Okay. Okay, so so on this page, I mean the summary is actually, you can go over it. So but what I want to say is like there is a TFA, is for fundamental analysis, and this website is pretty good. They tell you like all the revenue and also all the balances for the last few years. So it's a good website to study for its stock. And then the other one, Ticker-On, that is the technical analysis, and that one would have an AI. When they look at AI with a pattern, like head and shoulder, like pendant, like all kinds of pattern, they use the AI pattern to recognize a stock, to see if based on this pattern, and they will have a recommendation. And that's how we learned technical analysis. And my technical analysis is not strong. My fundamental analysis is not strong. But when you know a little bit on everything, and you study them like you are your own analysis, and when some people tell you something, you actually don't believe them. You actually go back, use some tool to validate what you see, and it is a feedback loop to yourself, and make yourself a better trader. When you try to pay attention, do not use the trading to equip yourself to be a better trader. It's not just tools itself. A lot of trading is psychology. So when I say that I put in one bullet point is trading, to me, a big portion of it psychology. You know why? Because like, let's say if you lose a stock and you look at the stock every day with red numbers, that psychology is testing. And when you have stop loss and then you get stop loss all the time, that is taxing. That's why I don't like really automatic stop loss. So that you have something that you have to be aware of. So the best book for psychology, that is the Trading in the Zone. That's the best book. You have to have a mental attitude. The mental attitude is all about learning. So if you have a mistake, you make a mistake, but you learn from it. You actually try to see you can do better next time. Then that is not a bad thing. That is actually a really good thing. In trading, you always learn something new. If you can gather the insight from a bad trade, like we always have something that is bad. Like for me, I don't use stop loss, and somehow it really get to me, and that is one of the things that I need to work on. And when I try to switch to really using stop loss, and it hit me so bad, my psychology is totally turned off. Then I because of the rule, if I lose certain money, I stop trading. So then I have to reassess. Then I have to, you have to learn it on yourself, and don't copy someone else. You can listen to other people how they do it, and then incorporate into yourself, because everyone think differently, everyone react differently. And for me, I have less fear on losing, which is not a good sign, because I don't fear of losing, and that's why I don't use the stop loss. But that is actually really bad for some of my trading. But I look at trading as not as one trade. I look at my trading as both the long term and the short term together, all together, because I use my long term to fund my short term. Because if the long term actually making money, then you allow me to be a little bit bold and a little bit like speculate. Speculation is a tool to, hey, try it and see what happens. So because when you use the rule of 1% on the short term trade, and you only trade it for 3 weeks or maybe 45 days, the worst come to worst, you lose that 1%, right? You can afford, I mean, when you have a plan in place that tell you that the worst that can happen to this short-term trade is 1%, then you are more comfortable to deal with it. But remember, you have to watch your psychology. Anytime that you have easy money, that's the time that you have to be extremely careful, because the more that you actually make money, you become over trading, and that's my problem of over trading. So I overtrade numerous times, and for example, okay, I can show you like some of my bad examples. Okay, so okay, this is my Roku stock. Can you guys see it? I'm going to blow it up. You guys see it, right? Can you guys see it? Hello? Okay.
Yeah, we can see it.
Okay, so what happened is the Roku I'm using like Strangle, so it's pretty good. Like for the first month, I do it for 2 months, December and January. Like every one of them is like $400, $800. You see all this, and then I have one that I don't, because like I do not remember what happened. It was right around 210, and all of a sudden like they have a bad earning of the release, and then you just go back down to 180. And I was not quick enough to stop it, and then this one totally take out like $8,000. But overall, I only lose like 1,600, but I was up by $3,000. So there are times that when you make money and you forgot to watch it for, because I'm not watching, because recently I was not 100% onto the market. I was really just kind of like play money. I was not really doing trading seriously. like most of my day was spending on my home and try to do like furnishing my home, and I learned how to maintain my home. So what I'm saying is, you have to watch your psychology. When your psychology that you have least kind of fear, that is not the right psychology. You have to have positive attitude, but you also have to have the psychology that you have to prepare for the loss. And I was not accepting the loss, and then it ended up to be losing even more. And because I'm not using the, so when I see the trade going bad, let's say you go from 200 to 180, I should have stopped it. Okay, so I should have like stopped that things with minimize the loss instead of a total loss. So I don't remember if this is total loss or I think it's a big loss anyway. So okay, let me see. Okay, so let's see. I want to show you that, like on this page, if you scroll up to the features article, so there are many articles that is worth your. So there are a few articles that I want you to take a look. This 101 probably not the best article, but it's like I started it and then I stopped giving more detail, but I'm gonna go back to it. So I have few of the suggestion is, well, actually this one is important. I think that for every people, especially those people that are starting new, CoverCore has to be used. So that way is to try to cut down your costs, and you have cash secure put is like in the view, then it's actually buying things at a discount. The LIP is extremely good. If you buy LIPs, instead of buying stock, you buy the LIPs is cash efficient. I like to buy the LIPs that is like 2 years out, 1 year out. That is in 70% to 80%. Like the delta is 0.75 or 0.8%. That means 75%. And those are really good because for every dollar you move, that LIPs also increase. But LIP also can lose money if you pick the wrong timing. So try not to buy LIP at the same time. Let's say let's say you try to get into AMD, I would say like you buy some LIP that is 9 months out, you buy some LIP that is like 1 year or maybe 2 years out, and you buy at some strike that is like 0.75, some strike that is 0.8. You can go for some strike that you have confidence you can buy at 0.7 or 0.6. Then it's like all those price that is like not closer to the at the money, then it will be cheaper or maybe a little bit far out of. But I was not put in too much money in out of the money because that one would really tank when the stock tanks, then it disappear. So it's safer to less risky to put it into in the money. Okay, so those are the strategies that I would say for all beginners. By all those things, then I would use one session to talk about these things. Okay, so on the feature articles, you have to look at the 101 TD 101, and this is like the trade. It's not okay. This one is for everyone's telling their kids, because this book I highly recommend because it talk about it's not related to trading, but to me, when I read this book, it tells you to find something that interests you. All your life, even when I retire, I keep on finding the interest that's something I can make money. For example, I am very interested in traveling, photography, and video taping. So I would be interested in doing like Airbnb and try to make something that is artistic, that sort of things. And those are my interests. And when I develop my interest into a hobby, you don't need to retire. That means you can work full time because you like what you do. Trading, I like it, but then I don't think I can do it long term. When I get to 65, I can't do it because just it's very taxing on the mind and also like really stressful. And the more that I trade, the more stressful I get. That's why I now try to diversify by holding into real estate, like try to have rental property so that I can diversify between the things. When you get to a certain point, you don't want to amass money for the money's sake. You want your money works for you. You spend your money. I rather spend the money on a vacation, on something that you have to see the world and help people on a good cause, that sort of thing. That is more meaningful, because at the end of our life, the only things that is left is not your money. Your money is going to be inherited to your family or something. But what is left is your love and your memories. Those two things are important. So there are times that you have to reassess, why do I spend so much time on my job on things that actually doesn't matter when you're gone. When you're gone, you are gone. So it's kind of pathetic view, but then you have to assess yourself, like ask yourself, what is your life goals, and see if money help you with those life goals. If your life goals is to see the world, yes, by all means, travel. If your life goal is to spend valuable time with your family, have financial independence like me, and spend more time with my kids after you retire. So this is number one. This guy is really good with all the his talk. So I highly encourage you to go over. So all these are the feature article that I talk about. So this is like trading. So I have samples here, like how, like why I justify the using. Like what I told you before, the short term, medium term, and long term, all are documented here. Okay, so you always learn from the setbacks. So do not be get into a depressive state and not stop trading. So the best way for you, if you're losing money, stop trading, stop for a while, but then never get don't be afraid to get back with one contract or maybe even 10 shares. Don't ever be fearful, because you need your confidence in the market. If you don't have confidence, you don't have a positive mental attitude, then you might as well forget about trading. You need those components in order to be successful. So when you lose that, then you really have to question yourself. Like don't jump into the market based on certain things. You have to be strong psychologically. So the psychology is this: you use a small trade to boost up your performance, you boost up your confidence. In order for you to perform well and think on your feet and not to falter, it's like, don't be greedy. Have a plan to restrict your greediness and restrict yourself from FOMO. Always have a plan. Before you open the market the day before, write down what you want to invest in, write down what are the trades to look at. Don't look at everything. Only concentrate on what you are interested in. Okay. And so there are some articles. Okay, so this one is like all the resources, the TDT resources. The ticker is all mentioned here. The ticker run is all mentioned here, and like all these things would really help you guys. Does it make sense? Okay, so okay, I don't like Motley Fool, and then like there are some books that I encourage people to do. That's for the technical analysis. This is a good book to have. And yeah, ticker dot. Okay, and then TIKR. I think I typed it wrong. So this is the trading in the zone is a must-have. You have to understand this. So there are two places to learn about options. One is the option alpha. The other one is the Tasty Trade. Although I actually think that the suggestion from option alpha is right on. Usually for beginner, it's safer with the option alpha. With the Tasty Trade, you have to be a little bit careful, because sometimes, because they are long-term trader, they are not catering for novice. So I would say like both of them are important. Try to go from on Tasty Trade. There's a learn page. It's like a blueprint of like where to go. So always listen to some strategy when people talk about butterfly, when they talk about what is a call option, what is the degree. Like the most important one is to learn is the delta. If you learn delta, that's most of what you need. Delta and implied volatility. Those are the few things that you once you pick it up, the rest will be easy. But don't have it like, oh, I don't understand it. I don't understand. The things that I want to stress is you don't need to understand all of this. It's actually bad to understand all of this, because like the more that you try to look at, the more complicated picture that you have, and it's harder for you to make a decision. I like my approach is close enough is good enough. Do not go for the perfect situation. There's never a perfect situation that your delta, your what's that? You know, that they have many metrics, but then I only look at delta for most of my stuff. Okay, so let's see. I think that's about it. So there's one article that talk about leaps. So one of the 3 fundamental options that I recommend, instead of going for expensive buying, the leap is more cash efficient. In terms of like, let's say you buy AMD, like you buy AMD like for 113 per share. You could have bought like some of the leap option for $20 a share, maybe even $30 or $40. Then it's like 1/3 of what you're paying for the stock. But then they move about like 70% of what the dollar moves. So in other words, it's more cash efficient. You can have, instead of having 100 shares, you can have 4. You can have like multiple contract, so equivalent to 300 shares or 400 shares. So those things are highly recommended. So go read this article that talk about the leap and the Pullman cover call. And this is one of the things that make me the most money. So the leap call, I actually like, let's say I have 20 contracts, right? By expiration, I usually go with sell the rest of it after the new year, so that my tax is not taxed last year, but I tax next year. And then I use 1 or 2 contract, or maybe like 3 or 4 contract, acquire some of it, because the leap contract is I buy at 70 delta, and if it actually like go up, for example, at like my AMD, I actually use the contract. I buy a bunch of them at $20, $30 going through the leap. So at that time, let's say when in 2016 or 17, most of the stock, it was ranging from 10 to 15. At that time, I was not buying in the money. I buy the one at 20, but it just happened that it goes up. The $20, before you know it, it's already over $20. But that's how I acquired the stock. You just pay $1 or $2 and buy the one that is like out the money. But for now, because the stock has gone up so much, if you buy out the money like 150, you might be still, it's a little bit dangerous. I think if the market tanks tomorrow, I expect AMD to tank because of the merger, the approval, the signing is going to be halted, and there is a thing called oh my God, I forgot the name, because of there's a conversion ratio. There's advantages to the silence. So AMD people would dump AMD and just try to get silence, but then right now it's already stopped. So whatever that damage has been done, because the people actually dump the AMD stocks and then get the silence stock, because they know that once the merge is over, that will convert that silence stock to 1.7277 or 1772, together with a dividend that is supposed to be released. So those people already done their part. So that's why I expect that explained the reason why AMD was down even more than other people. That is on Friday, and because once you get halted, you cannot trade silence anymore. But whoever that is on the silence is going to convert the share to AMD. So there's a thing called arbitrage, and that people trade the arbitrage way to, because there's a gap between 1.72 and the current price of silence, giving you probably 1.55 or 1.6, and that means you actually are at an advantage if the merger is approved. So I expect tomorrow to go to probably like it's hard to tell because it is down already so much. So but long term, my view is still a positive. because the long-term view is good because Xilinx and AMD has a lot of synergies together. They have been in the business, so AMD is going to have more arsenal into the high-performance computing, not only for CPU, GPU, but also on the FPGA. The FPGA is actually using inferencing for AI, and back in 2018, they built the fastest inferencing engine. You know, it beat the GPU side like hands down, and they proven themselves. They work together. So God knows, in between the merging, that kind of talk, they may have like some sort of product roadmap going out. So I expect it's going to be like a good things in the future. But when would that happen? I have no idea, because if I tell you that, I would be lying, because the timing is always, I get the trending right, but I always get the timing wrong, because I mean, like, I don't know like the roadmap when they are going to release. And also there's a macro picture. So be very careful, pay attention to the macro picture, the interest rate. And I highly encourage everyone to subscribe to have watch the Bloomberg. I watch the Bloomberg TV all the time, especially the one in Europe section and the one in the Asian section is absolutely excellent. They have people that analyze not just the overall market, they analyze the economy. They also integrate a lot of good company across the world. They interview the CEO of Pfizer. They interview AstraZeneca about the COVID ID. So it's complete coverage. They interview Lisa Su, just ask her, like all the important people, they always interview. So you get exposed to different kind of company that you otherwise don't even know about. And this, I like Bloomberg because they seem to have really senior people. When they say something, you can trust them. Not like CNBC. CNBC is total piece of crap. If they tell you something, you can actually try to bet against them. You know, like your likelihood of getting money is actually higher. So don't trust anything on the side, like something like what if you don't listen to those. All those are garbage. All those are just like you can be your own analysis and do better than them. So that's my. So I think. Okay, so right now it's 8:20. I think I need to close this down, and I think for next one, I'm going to go into more, try to go in depth into the TD 101, talk about the cash secure put, how I use the cover call and the viewing and also the lead. So I will go that in depth. So I will open up now to all the questions. I hope someone can ask me some questions. So make it, just don't be afraid to unmute yourself and you can ask questions. Joe, come on, Joe. Hello. You have to unmute yourself. You have to, there's a mute button. You have to unmute yourself. See if you can. I don't know. Oh, I don't know what that means. Maybe by default I mute everyone, but can someone actually unmute themselves?
Yeah, I can unmute myself. Yeah.
Well, maybe tell other people how do they unmute. I mean, there's an icon button to mute. Try, so there's an icon button. There's an icon button to your left. You said mute, then you can mute yourself.
Yeah, you just hold space and then speak, and then it will let you speak, and then when you're done, just let go of space.
All right. Well, anyway, so if you don't ask question, I'm going to. And who just speaking? Is it Johnny?
Yeah.
Yes. Well, see if you have a question for me.
Who has a question? I mean, I have a lot of questions, but I can ask you questions all day.
Because I think nobody is asking any question. I'm kind of like waiting for questions.
Yeah, I guess my question is mostly, since you say you don't use stop losses and just, I guess, I think the biggest
I
risk
would
with,
use stop loss if it's 0DTE trade. I don't use stop loss if it's a let's say I have a strangle, right? I usually don't like to use stop loss, and I use stop loss the last minute, meaning that when I try to get rid of it, then I will use the stop loss. But so when I enter a trade, I don't enter. Let's say I acquire stock in Strangle currently on Strangle on Roku. If I use stop loss, I already out of the pictures. But because I don't use stop loss, I can do adjustment, because Strangle, when you attack on one side, I don't adjust the side that is attacked. I adjust the side that I roll the side that is winning. I roll to next period. So let's say I got attacked on the put side. Let's say Roku is like 160 or something, and let's say it has not reached my side yet, and then I make money on my call. I would just roll the call to next period, because when you attack me on the left side, let's say I get a side, then I can adjust the call. I can roll over the call to next week or 2 weeks later to be something that is like getting me some balance to be, let's say currently Roku, let's say it's 160, I would sell the call at 170, 180 to see if I can make up the losses. So I don't use stop loss. I don't like stop loss in that kind of scenario. Instead, I use the strategy to defend a trade. Like, if you trade 0DTE, especially iron flag, you have to use stop loss. That you cannot, because you're moving so fast. If you don't use stop loss, you would be dead. Like a lot of times when I don't use stop loss in that is the bad idea. You can easily lose out a lot of things. So when I say I don't use stop loss, I don't use stop loss for the swing trading that is over weeks of time. I rather use the time element and also like my skill set in adjustment. So there's no right or wrong. I don't judge people using stop loss, but for me, I get burned by stop loss so much that I just try not to use it.
Yeah, I mean, I guess my question is, when you don't use stop loss, there's always certain stocks that sometimes will drop, or like, let's say in early 2020 when the market, crashed like big, and you're gonna see all this red in your portfolio, or even just recently, maybe in like November.
Yeah, but
Market's
my
crashing
question,
big on certain high beta stocks.
If I really use stop loss on all my portfolio, I'd be dead. I would be, well, maybe I'm happy, but the thing is, so stop loss really stop my psychology. Let's say I have 5 stocks, every one of them gets stop loss, but because some of them, if you're long-term holding, I do not use stop loss. I rather assess the situation, and then let's say your plan is to not to lose more than 20%, right? And then when at the end of the day, you something that tanked really bad, and then you set the stop loss tomorrow. You don't set stop loss right at the beginning of the trade, because that is like, to me, is a lack of confidence, and it is a psychology taxing, because you always worry about the stop loss going to be executed. Because I like to be in control, meaning that when I enter the stop loss, I don't mind. I actually at that time I don't mind to stop out in the market order or stop out in limit orders, right? You have the control. I don't like it to, when you enter the trade, you enter one profit, and then what the control side is like, either you win by that much, or you lose by that much. So that one, when you use that type of stop loss with like I don't know what they call it, is one, like one execute the other, like you take one over the other. I like to use it for COTT trade, or something like in futures. When I trade futures, I do use stop loss, but most of the time I try to use the swing trade for the futures, so that, or now I don't even use stop loss. I use future options. So the idea is, you buy a contract that is long, and then you go the opposite on the future option. Then you go a month out, then you buy long, and then you probably like sell a call, or maybe buy a put, or something like this in that nature. So to balance out the delta. Sometimes it's not totally balanced out, but it means because the way that you use the future options, the benefit of it, sometimes the market is consolidation stage, meaning that you go up, you go down, you go up, you go down, and then you try to benefit from both sides. When you go up, you're long on the contract, make money. When you go down, your opposite side, the bank on the bearish side actually make money on the option side. And then sometimes you go down and then you go bounce up, then that means like you actually gain on both sides. But of course, there are times that you actually, the hedge can only make up some of your losses, not completely. So there are different strategies to hedge against your portfolio. And I actually like to use option to hedge against my overall portfolio. Let's say I have a bunch of AMD stock, bunch of stuff, and I like to sell cover call and I like to sell cover strangle to offset the loss that I have when the overall market downturn. I sell those as a premium to make up the losses that I have on the stock. So that is a hedge. That's a hedging mechanism. You go the opposite way of, or maybe going neutral. So let's say you are bullish on a certain stock. You use by all the option strategy that is neutral stand or maybe bearish stand to go against that stock that you own. So you're playing your devil advocate. On one side, you long, and the other side, you short. But normally, I don't do the hedge until I have a problem. So your mileage may vary. Some people like to hedge from the very beginning so that to have some protection, because by the time that the market tank on certain stock, when you do the hedge, it's already too late. But that one, you have to do it like actively try it out and use your own method. Right now, the way that I do it is I don't hedge until I see something that, oh, I was wrong on that approach. Let's do some hedging so that I don't completely lose on the long end. I make up some loss. And most of the time, that approach give me some idea that because market overreact. So when you hedge with the market reactions, right? You hedge the same way as the market return. Let's say it's downturn, then you make money. But if it's really an actual reaction, an overreaction, then that long term will stay on. Then you try to make money on both sides. In the meantime, you lose some money because of the market reaction, overreaction, but that market overreaction is benefiting your hedge. You have a hedge as a neutral strategy too, because when the market volatility goes up, the wicks go up, all the premium, the implied volatility goes up, and your premium is bang on to have money. So that's the good thing. I don't suggest people to go buy and hold. I suggest people buy and hold on one side for the long term, and then use option to trade for the income. So, but on the other hand, I don't recommend people just go strictly on short-term trading. I think like you guys have, I mean, the money that I got from AMD or Alibaba or Nvidia, I would say like 80% of my portfolio is really bang on. It's really coming from my long-term view on certain stocks. So when I have a long-term view, those are big money. When I make big money, I'm talking about 300%, 400%, even 500% of like some of the stock. Imagine I buy AMD at $12. The recent trend, you go to 165, and I sell many of them at 150 or something. I sell 3,000 shares at 135 or 150. I don't remember, but that's from 12 to 150. You think about that. That is like a 4 years holding, that sort of things. And I get it at 12, 20, 12, some at 12, some at $20. Even at $20, you multiply by, like 8 times, 800% return. So you don't get 800% return by trading monthly or trading daily on option. You get 30% return in a year in short term, but you never get the type of. So I would suggest you to have a long-term view on the stock, because you are a better trader if you study stock. Don't study the option, study stock and option all together, because those things are hand in hand, work together. If you just trade on stock, you can only expect your portion coming from a trend of like maybe last year is a good year. The whole first 9 months was beautiful, but the last 2 months is just tank for me. So, but then I have a long-term view. Whatever that is done, I know that I can get back on the long-term view of the things. In the meantime, it would be very painful. So I encourage everyone not to have a short-term view on the portfolio. It's okay to be red. There's nothing wrong with it. I have many red. I have more red than green. I told people, don't look at it. Just don't think about it. Don't use it. If that stock, whatever that you're holding, that red actually affect your sleep, you are trading it wrong. You should apportion in such a way that the 1%, 2% is not going to hurt you fundamentally on your portfolio. Do not trade over something that you lose sleep. Then that you are trading it wrong. You have to do yourself a favor. Anything that you put in the market, you have to be confident. Don't listen to other people. You have to be your own analysis. And when you lose money, it's on you. But don't blame yourself, because you are in it to make the long haul to be financially independent. Anybody lose money, I lose them. I fuck up the most compared to all of you guys. So that's why I tell you guys, it's okay to lose money, but have a long-term expert. Don't go short, liquid short for liquid for everything, because you would deprive yourself like on. Don't go too crazy. In other words, hold some cash and hold some cash and study the company that is worth investing. Does that make sense? All right, I think it's getting out of my time. It's 6:34, so I will end now. Is that okay with you guys? Hello?
Yeah, thank you.
All right, so I'm going to stop the recording now. Oh, damn, how do I stop the recording? Oh, stop. Okay, I can stop.